Topic for this session today is financial analysis for stock investing. So the keyword here is financial analysis. So again, this is standard disclaimer. Please take note, I am here on education purpose. Make money, be happy. Lose money, don't scold me. Okay, before I go through the nitty-gritties of what I mean by financial analysis, okay, what involved in a financial analysis, I want to explain why is it important. Okay, why is it important, and especially for this year, why performing financial analysis on companies, which is important now. So again, for the benefit of those who are really new to this, financial analysis, basically look at the numbers. Okay, using numbers to tell the stories, using numbers to justify whether is this a good investment. So maybe if you're totally new to this, just have this in your mind. That's what financial analysis means. And why exactly this year is actually important, especially for this year. If you can recall, this is actually at the beginning of the year, which I still think it holds. Singapore economy growth slow at 3.8% in 2022. Outlook darkens for 2023. So basically, a lot of analysts making prediction that this year, 2023, is not going to be very exciting. Okay, is economic wise, it doesn't look too good Okay, I think for obvious reasons, we have inflation, we have interest rate increase, the war is still going on. Okay, the pandemic hopefully is tailing off, but as you all know, it's not totally gone. Okay, so many has actually predicted a recession for this year. Like for example, in this article, economists in Wall Street Journal survey still see recession this year despite easing inflation. Okay, now, so what does it mean when we actually convert this in terms of the stock chart? Okay, if you were to ask me predict, so this is my prediction, my opinion. Okay, of course I can be wrong, but of course I also have my rights to do opinion. So based on the background I mentioned just now, we have inflation, we have interest rate, the war is still going on, and people are thinking of recession. I personally believe that the market is likely to have a general downward trend. Okay, this is what I personally believe. Again, I can be wrong, but I just want to put a picture on your head, or in your head, when we talk about recession, how does it translate into a possible chart movement? Okay, so this is how it looks like. Of course, this is a prediction. This is my opinion. However, I think it's not just one straight line down. Okay, very likely is going to be very volatile. Okay, again, it's something that we have seen. Okay, for those on the market, you realize now when if assuming my prediction is correct, so the financially weak companies will suffer the most under such scenario. So think about this. If let's say, for example, market is actually going down, as an investor, what kind of stocks will you throw out first? Of course, those are the weaker companies, or the companies that have a less tendency to take shocks, or companies that tend not to be able to survive well business-wise. Okay. In environment which is a lot rougher. Okay, so financial weak companies will suffer the most under such scenarios. Okay, and at the same time, okay, when the market is low, it's actually a good time to pick up good companies at attractive valuation. So okay, life is very fair. Okay, there's actually both sides. So of course, when the market is down, okay, some companies will suffer, but at the same time, it's also a good time for you to acquire good stocks at attractive valuation. Okay, so basically, long story short here is this, okay, especially at this point in time, because the volatility is going to happen more and more often, it's actually quite dangerous will hold financial weak stocks. Why? Because they will be the first to come down. They will actually suffer the heaviest loss. Okay. And of course, this is the period whereby you may have a lot of opportunities to actually get good companies at attractive valuation. So very important, you have to know, hey, what is a good company? How do you actually spot a good company? And this is precisely why this period of time, financial analysis is actually more important. Okay. I just want to be very clear. Financial analysis to me is always important. Okay, financial analysis to me is always important. But let's say, for example, when we are bull run, okay, the joke is always this: you close eye, throw dart, you also make money. Okay, I still remember at one point in time, like for example, if you just go and gamble on stocks at Tesla, okay, when it was having a bull run, okay, you know, you will make money. Okay, unfortunately, I don't think this is the period of time. So this is the period of time whereby we must really know what we do. We must actually pick up good companies, and financial analysis is important. Of course, eventually I would encourage, whether good time, bad time, we should actually look at the numbers of the company. Okay, so if there is any questions, feel free to just type in onto the chat. I will try to answer as soon as I can. If not, I'll just leave it to the end of the session. So now I actually want to dive into detail of case. So yes, you're convinced that, yep, I need to get a good company, and you're convinced that you should actually do more financial statement, financial analysis. So what do I mean by financial analysis? What are the exact steps, or what are the things that we have to do for financial analysis? So financial analysis can actually be broken down into three parts, or either that, you know, to spot a good company, to identify a good company, or either that to prove that this is a good company, we can actually, you know, do three things. Number one is, of course, we have to understand the financial sustainability. Okay, is the company financially healthy? Does the company have financial muscle? So if, let's say, when the market is no good, when the economy is no good, do they have the muscle to actually ride through the wave? COVID is a good example. You can see that actually a lot of restaurants cannot last. Why? Because they probably don't have reserves that last them more than 3 months. Okay. At the same time, there is a lot of restaurants, or in fact, a lot of business that actually last through COVID, despite being empty for 6 months. Why? Because they have the financial muscle to do so, or what we call the financial sustainability. So are we able to see how financial sustainable a company is? Of course, from the financial statements. I'm actually going to give more examples later. Okay, next, valuation. Okay, so this again, like I said, you know, this is the period you must know what is cheap, what is expensive, very important. And of course, the numbers can help us to see. And lastly, the business results reflected in financials. So of course, you know, when we try to, end of the day, what is most important in analysis is the business analysis. Okay, where we actually want to define or want to assess whether this is a good business or not. Okay, most important is actually business analysis, and we want to see that the business results is actually indeed reflected. That is most important. Okay, so let me just dive into the details. Okay, let's start with financial sustainability first. So, you know, what are things we can actually do, okay, to actually understand whether this company is financially sustainable? A very important exercise we can do is actually this thing called the cash flow analysis computation. So basically, this thing called the net income after tax is actually called accounting profit. Accounting profit, and accounting profit is not equal to cash profit. So accounting profit is there to help for the calculation of tax purposes, and it's not equal to cash profit. So what is a cash profit? So cash profit is the actual cold hard cash that come to the bank that can tally the bank. That's called cash profit. Okay, So in that sense, the first thing we have to do in the cash flow analysis is actually see this. We want to make sure that a profit is actually being converted to cash flow. Okay, profit is actually being converted to cash flow. So there are some companies with lousy profit, but good cash flow. Okay, I think that's okay. But there are some company with very good profit, okay, very good profit, but lousy cash flow. Those are the ones that you have to be very careful. Okay, like for example, take a look at this. Take a look at the numbers. Is this numbers we can accept or not? Yes or no? Okay, don't mind just no right or wrong answer. Okay, hopefully more can participate. So I just want to see that the income is actually being converted to cash. So for cash, we look at cash flow from operating activities. Do you like what you see here? Yes or no? Okay, can I get some answers? Okay, thank you so much. Yes, you can see that, hey, this company, you have making steady profits and is indeed converted to cash flow. So these are some of the things we actually look out for. Okay. So I just want to throw random examples. Of course, if you do join the program, it's actually going to be more structured. Then we have to, there'll be a proper framework. But I just want to go through this concept so that you have something to bring back after attending today's session. So again, things like borrowing versus repayment, something we can potentially see red flags of the companies. Okay, so there are some companies whereby basically they just keep supporting their capexes through borrowings. Of course, again, something that we will be a bit concerned if they borrow too much. So how do we know what's too much, too little? So of course, from the numbers here, we can have a sense of it. Okay, not done yet. One of the things that I actually find it quite important is comparing cash from financing activity versus what they call dividend payout. Okay, the last part of financial sustainability is actually do a lot of ratio analysis. So basically, you actually learn about the 5 main ratios you actually look at to help us to see whether this company, if let's say, for example, really hit a bad patch, can they actually survive? Can they actually ride through? So these are some of the ratios that can actually help us to see, hey, whether can they sustain the hard knocks or not. When we actually look at the annual reports, when we actually look at financial analysis, we don't just look at the numbers. Okay, so in the annual report, there are also a lot of very good information. Okay, next, to see whether is this a good company, we look at valuation. Also, some of the very common things we actually look at is, of course, the P ratio, price per share divided by earning per share. Also, this is actually a very good ratio to help us to see whether, hey, this stock, is it cheap or expensive? Dividend yield. So that's again another good indicator. Also, to see whether, hey, relatively speaking, a lot of times you actually compare other stocks. Is this company giving good dividends? Is this a good investment? And price. Okay, lastly is actually, looking at the results. Looking at the business, looking at the results. Now, one thing we can do quantitatively is actually comparing the capex versus their total assets versus the total revenue. So of course, the ideal case here is this, your capex keep going up. And once your capex go up, your asset increase. Okay, makes sense, right? Because you actually invest in assets, invest in machines, so on and so forth. Okay, your assets actually go up. And after that, it actually get translated into revenue. Okay, so like, for example, this company, this is a good example whereby what we see is, hey, the business actually proven out to turn well. You have the capexes that actually keep going up. And once the capexes go up, their asset actually increases. And, it actually converted into money coming in. Okay, so we see this as a very good picture. So of course, not all the companies are like this. There are companies whereby your capex actually go up, and yet your asset don't go up. Your revenue go up. Then of course you'll be worried. There are companies whereby the capex keep going down. It's like, hey, this company, is it still investing in itself? There are companies, of course, capex go up, asset go up, but doesn't convert into revenue. Okay, also this is a quantitative way for us to see whether, hey, does their business actually reap result? Of course, for business analysis, we cannot just do it, look at numbers. We have to combine it with the qualitative aspect. We have to combine qualitative aspects. So we have to understand what is the company's plan, like for example, through reading their chairman's statement, and of course, to do our own analysis. So, one thing you can actually learn is we actually have certain framework to help. Okay, so at the end of the day, what we actually have here is this: we actually have this framework, whereby we are able to compare companies. Okay, so a lot of time it's very hard to find a perfect company. So let's say, for example, this company financial sustainable, very good, okay, but valuation may not be very attractive. Or this company business is very good, but financial sustainable actually may not be there. So when we actually go in terms of stock investing, okay, unfortunately, of course, when we find a perfect company, then it's easy lah. Well, we just buy that company. But a lot of times, it's easier for us to decide, is this a good company by comparing?